Hello, welcome to the weekly technical analysis review here at xm.com. I'm Rafi Boyajian, currency analyst, and today is Monday, October the 31st. Today we will look at oil futures as well as the Aussie and the Kiwi versus the US dollar. We will start with WTI oil futures. WTI futures have seen momentum decline sharply over the past 1.5 weeks, although they have so far managed to hold above the 50-day moving average. Prices have found immediate support from the Kijun Sen line, which is currently around 48.20. If oil extends its losses further, the next support will likely come from the 50-day moving average at 47.60. A drop below the 50-day moving average could accelerate the decline further towards the Ichimoku cloud. The near-term momentum is negative as the stochastics are deep in bearish territory. However, at below 20 there is the possibility of an upside correction, as this suggests prices are oversold. Other indicators are more positive, as the MACD is still bullish above zero, although the red signal line is sloping downwards, while the purple Tenkan Sen line remains comfortably above the blue Kijun Sen line. A move upwards will likely see prices finding resistance at the 49 level, while above that 50 would be the next key level to overcome. A more important barrier though would be to challenge the yearly high of 52.21 set on October 19, which it needs to break above if oil is to sustain its positive outlook in the medium term. Our next analysis is the Australian dollar versus the US dollar. AUD/USD has been in a neutral range since retracing 88% of the April to May down leg from 0.7834 to 0.7144. The pair has failed 3 attempts to break above the August peak of 0.7755 and has been hovering around the 50-day moving average since. Prices are currently just above the 50-day moving average, which has been acting as both support and resistance at around the key 0.76 level. With RSI just below 50, the near-term momentum is neutral. If the pair heads south of the 50-day moving average, support will likely come from the 61.8% Fibonacci retracement level of the April to May down leg at 0.7570. Further declines would bring in focus to 50% Fibonacci level, which is also where the 200-day moving average is currently converging at 0.7485. A break below this level would shift the medium-term outlook from neutral to negative. To the upside, the nearest key resistance is the 78.6% Fibonacci level at 0.7685. A break above this level is needed to generate strong enough momentum to test the August high of 0.7755 and to subsequently challenge the April high of 0.7834. Our final pair for today is the New Zealand dollar versus the US dollar. The Kiwi versus the dollar recently broke below its upward trending channel, threatening to derail the rally that's been in place since January. The move saw prices slip below the 50-day moving average and below the Ichimoku cloud. This short-term bearish bias has weakened in recent days as the Tenkan Sen line has crossed just back above the blue Kijun Sen line, and the MACD is trending up, though it remains in negative territory. If prices extend their losses, immediate support will likely come from the 0.71 level, while a break below that could see prices falling towards the 200-day moving average, currently at 0.6988. If the pair is unable to hold above the 200-day moving average, this would be a bearish signal and possibly a sign of an end to the rally. If the current negative bias continues to subside though and prices head higher, the pair would first have to overcome resistance at around the 0.7180 area, which is where the Kijun Sen and Tenkan Sen lines have flatlined. A break above this area would open the way for prices to climb back into the Ichimoku cloud and to eye the 0.73 level. A break above the key 0.73 handle is essential if Kiwi versus USD is to resume its uptrend. Thank you for watching and have a great day.